Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you who are joining me here on the East Coast. We'll say good morning to those of you who are joining us from the Central Time Zones, Mountain Time Zones, or Pacific Time Zones. Of course, good evening to any of you who are joining us from across the pond in parts of UK or parts of Europe, and good early morning if any of you are joining us from parts of Asia or from Australia. Before we begin, I just want to ask everyone in attendance right now, we got a lot of more people joining us in the room today, but I just want to know if you could reply back real quick and let me know if you can hear me okay, if the sound is coming through okay, if it's coming through clear, and if the volume is well. So if you can just go to the GoToWebinar control panel that popped up when you joined the webinar, let me know if you can hear me okay. Okay, Bob says yes, Deborah says yes. Luke says can hear just fine. All right, so it sounds like the sound is coming through. Fantastic. Well, welcome to today's presentation. We wanted to touch upon what is possible with radioactive trading, meaning what are our expectations and what are our possibilities with applying the different income methods that are discussed in the blueprint and the home study kit and that we use in our personal accounts for the radioactive trading techniques. Last Thursday, we discussed why we would use radioactive trading to begin with. And we talked about how the radioactive trading setup forces us to apply the three core principles of trading. Not just the three core principles of radioactive trading, they're really the three core principles of any option strategy. The decay line, the time value decay line, which puts time value in our favor, forcing an ideal size trade so we're not taking on too much risk or too much leverage, and then, of course, the at-the-money bell curve to allow us to manipulate time value. The initial setup allows us to limit risk up front and avoid the lie of leverage. And we pointed out, and we really emphasized, that the insurance we're using in the radioactive trading married put setup is not money thrown away. It's an asset that can be used to apply those three core principles to put us in a better position. And we also discussed, of course, why the other common and sexy option strategies do not solve the problems that we commonly faced as investors. If you missed that webinar, after today's presentation, you'll be able to go to radioactivetrading.com, click on the free webinars tab, and you'll still be able to watch that presentation later on this afternoon, or I can email you the link to it if you send us an email to support@radioactivetrading.com. Again, the initial setup, how do we apply this in our account? Well, we're going to be able to purchase a stock or an ETF when we open any position. We are looking for stocks and ETFs that we feel are going to move up in price. However, these positions can be applied in a bearish market as well. We're going to purchase at the same time a far out in the money put option. We're going to look at least 5 months out in time. We're going to keep the put option less than 20% in the money. We don't want to go too deep in the money as there's such a thing as too little risk. And this is going to force us to get into a position where we apply those three core principles and we put the market in our favor. Bill says, can I get a copy of last week's? Yeah, Bill, after today's presentation, I'll send you a link to the YouTube video for that. It'll still be up on Radioactive Trading, but I'll send you the YouTube link so you can access it at any time. All right, so what is possible with these radioactive trading techniques that we apply in our account? Well, the first one is obvious. We've entered into a limited risk position. Any radioactive trade we open, in the absolute worst case scenario, the most that we're going to be able to lose is about 4, 5, or 6% on the position. This stacks the market odds in our favor and helps us avoid the martingale, or what's known as gambler's ruin. What is possible after opening the position? Well, the blueprint and the home study kit discusses 12 different ways. There's really 13. I'll talk about that later, that we can use after the initial setup to generate income, of course, to generate income in our account and reduce the risk of the initial position. We can adjust the insurance asset, the put option that we bought, to also limit risk or reposition the radioactive trade. We're going to be able to manipulate time value in both cases, whether we're looking to generate income with one of the 12 income methods or adjust the insurance. We're going to manipulate time value in our favor, which, let's be honest, as we discussed last week, time value is really the true profit of any options position. Then there's the potential for bulletproofing. What does bulletproofing mean? Bulletproof means we can take a position that had that initial small 4, 5, or 6% at risk. We can reduce that risk in the first couple of months, hopefully, potentially, and have a position now that has no risk to the downside and still the potential for unlimited upside profit. This means that you can go through earnings, you can go through black swan events, you can go through any kind of boardroom scandal or anything of that nature without fear of the market or fear of losing money on your position. The initial married put setup is shown here on the left, where we have that limited risk to the downside and the unlimited upside profit potential. As we apply the different income methods, we're going to reduce that gap. Okay? We're going to reduce the risk amount on the position. And as we continue to go forward, we can shorten this and shorten this and shorten that risk on the position until eventually we could be bulletproof, meaning we're guaranteed a profit even if the stock collapses. We can still apply other income methods as we move forward, and we still have the opportunity for an unlimited upside profit potential. Okay, that all sounds great. And many investors that I've talked to over the past 7 years or so since we here at Power Options got connected with Kurt Frankenberg, and I've actually been trading these adjustments in my account. Well, the question comes up is that it's too complicated. Why do I need 12 different income methods? Is it too much for one scenario? Is it too complex? The blueprint breaks down when we would use each income method and in what scenario. If I opened a RadioActive Trade, we're going to see examples of multiple scenarios today, but if I open a RadioActive Trade and in the first 20 or 30 days the stock moves up, I would look to maybe apply income method number 1, just simply selling a call against the position. Okay, common thing. We figure, okay, I opened up a married put. Why not sell a call against it, create a collar? That's the first thing that Kurt started doing when he created the RadioActive Trades. Income method number 3 and 4, they're going to allow us to manipulate the time value of our asset, the insurance, which again is not money thrown away. The put option that we bought is a second asset that we can manipulate to lower our risk and put ourselves in a better position. Or we could use no risk spreads, the nested spread trades, number 5, number 6, or number 11. Or we could use a combination of the income methods. We're going to look at that today too. If I open a position with the expectation that the stock or the ETF would move up 5 to 6% in the first 20 to 30 days or less, and it doesn't, the stock stagnates, well, I have the opportunity to use income methods number 7 or number 8, or I could use income method number 6. Okay, if the stock falls in price from when I opened it, I can readjust the position using income method number 9. I could perhaps choose income method number 12, or I could use a combination of others. And if I'm looking at a potential position I want to get into, and I'm expecting a move but I'm not sure, I could use income method number 12 or income method number 3. I'm going to cheat a little bit today, and I'm going to tell you right now that I'm going to show you examples today of income method number 1, income method number 4 with a 3 twist. We're going to look at stocks that have moved down, and I'm even going to show you a tease of income method number 12 on what really happened on the stock that moved down. Jay commented, what about income method number 2 and income method number 12? Income method number 2 is a reaction. It's not a standalone income method, but it is. It's a reaction to what you would do after you maybe applied income method number 1, number 5, number 6, number 11, possibly number 8. Okay, it's a reaction after you've done an income method. The blueprint not only teaches, of course, when to use each income method, but what to do when you adjust the position. And Robert, of course, is what happened to income method number 10. So 2 is done after the fact as a reaction if you have one of those other income methods open. And income method number 10 is a choice that we use when we first open an RPM. And I'll explain that a little bit later. I'm not going to give every income method away for free, but I will give you a lot today, but I'm not going to give you, of course, all of the details of each one. We're going to show what is possible. So, why are there so many choices? Well, because there are different market scenarios and different risk tolerances for each investor. Think about this. If I have just a covered call position open, and the stock moves up above my call strike price, I can allow the covered call to be assigned, take my return, and move on. I can roll the call up. I can buy to close my call and roll it up in price. Maybe I can get complex, and I can add a spread trade on top of it. But we're talking about only 3 different ways. What if the stock moves up, but now I feel it's going to pull back? Do I let myself be assigned? Do I roll the call up and then try to make some other adjustment to hedge the downside? Do I just get out of the position entirely? Okay, so different market scenarios are going to dictate the need for a fuller toolbox, a fuller set of tools to use in various market conditions. For each one of the income methods in the blueprint, we discuss what's called the SIGA model, which is an outline and a decision matrix that describes which income method we are going to use based on the conditions of the market, what has happened to our position, our expectations going forward. Of course, you don't have to be a great stock picker. You don't have to have a market edge to pick the expectations. But if you have a feeling that stock X might continue up, then that's going to help gear you towards an income method. And if you apply any of the income methods correctly, even if your forward-looking expectations aren't true, you'll be in a better position with a lower risk if you're wrong, or the potential for higher profit if you're right, so you can't miss. Goals. What are your goals for the position? Some of us might look for continued growth, and some of us might look for more income and more premium generation. We'll talk about that as well. Based on that, it's going to determine our action. What income method are we going to do? So the conditions, the expectations, our personal goals as investors. I may have different goals on the same position I'm in with Kurt. Ernie might have different expectations and different goals than I have if we're in the same position. And that's perfectly fine. We might choose 2 different income methods, but we're both going to be in a better scenario moving forward. All right. Now let's talk about an actual example. On Thursday, this is the example we used for the Texas Instruments position. On May 16th, roughly about 30 days ago, we could have bought shares of Texas Instruments at 58.05. If I was opening a married put, now I'm going to say honestly, this is not my actual trade. I am in Texas Instruments in the Fusion portfolio at RadioActive Trading, where our Fusion subscribers can follow Ernie's trades, my trades, and Greg's trades and see Kurt's track record. But I did do an adjustment close to the same day on the position I was already in to bulletproof it. But here's an RPM example. We'd buy 100 shares at 58.05. At the same time, I'd look to buy a put that's in the money and several months out in time. Okay, so I may have looked to buy the January 2017, so roughly about 240 days out in time, for $540 or $540. My total invested would be $63.45. I paid for the stock, I paid for the put. If I did 100 shares, it'd be $6,345. But remember, purchasing the put guarantees that even if Texas Instruments fell to $1 per share, I'm guaranteed to get $60 back. I can force someone to buy my shares of stock at 60. That's the right I have by purchasing the put. So in the worst case scenario, I'm only risking $3.45, $345 per 100 shares, or 5.4% of what I invested in the position. Now here's the basic profit and loss chart. As we see here, of course, I've got the number set up for us. If we bought the stock and the put and paid out $63.45, we have the 60 put in place, so we're guaranteed an exit, and our risk is the 5.4%, and the upside profit potential is infinite. Now, first thing we see is that, well, I paid a total out of pocket of $6,345 at that time for a stock that was trading at 58.05. Did I just throw away $540? No, I did not. The worst case scenario, the maximum risk here shown down at the bottom on the blue line of our hockey stick graph, is at expiration. If I held the married put all the way to January expiration, decided to take no income, somehow managed to refuse dividend payments, and the stock was trading below 60, then yes, I would lose 5.4%. The curved red line here is showing us the profit and loss chart at the halfway point. In this case, it's October 4th, 2016. That's from today. When I opened the position, it was September 21st. But notice that we see a profit here if the stock's trading at $60 on October 4th. I don't need it to be trading at $63.45 and we see the green line here where the stock is currently trading, we'd be at a profit at the halfway point. Why? Because of what we discussed last Thursday, setting up the position with the put far out in time means we're not going to experience a lot of time decay. The put is going to retain a lot of its value. And remember, I paid $540 for the put. I'm not $540 down the minute I open the position. If we open the Texas Instruments position on May 16th by buying the stock at 58.05 and buying the 60 strike put for January at 540, I could have turned around instantly and sold to close the put for 530 or 535 and sold to close the stock for maybe 58.05 or 58.10. All we're risking when we open the married put position is the bid-ask spread. I'm not down 540, I'm not 540 behind the 8 ball, I'm not 345 behind the 8 ball. The put is an asset that we're going to use over time, we can use over time with various income methods to manipulate the time value. All right, so about 10 minutes ago, well, actually a little bit more than that, but about 30 minutes ago, today, June 14th, about 29 days into the trade, remember we paid $58.04 to $58.05 for the stock alone. Stock's currently trading at $61.50. Interestingly enough, that's a gain of $345, or about 6%, which was the true risk on the position. Now the put, our 60 strike put was purchased for $540. The stock's trading at $61.50, so our 60 put is out of the money, but it's not worth 5 cents. It's not worth 10 cents because it's a January put. It's close to at the money. The put option is at $430. So we've gained $345 on the stock. We've only lost $110 on the put, or about a third of the gain that we have. We own both securities. Okay, so we're still ahead, $245 on the position. We could liquidate the married put right now for a gain of 3.8%, which is not a bad turnaround for a 29-day trade. Okay? And also note, the stock's at $61.50. The static, what we call break even, based on our cost basis for buying the put at 58.05, I'm sorry, buying the stock at 58.05 and buying the put at 540 was 63.45. Okay? We're not near 63.45, and we could close now for a gain of about 3.8%. We're not near the break even. That's the advantage. Where again, we weren't down 540, we weren't down 345 when we opened the married put. The put is an asset that can be controlled, and we can be manipulated. Now, the obvious choice, and that's why we call it income method number 1, okay, is selling a call against the position. Texas Instruments has moved up. It's trading at $61.50. I could generate a good premium by selling a weekly or maybe a 1 month out 62 strike call. I want to be a little bit out of the money. I don't want to be in the money. Really, again, one of the 3 core principles we discussed on Thursday, I want to be at the money. Okay, so that generates the most premium. Since we waited for the stock to move up, we're going to get a better premium and not trade against ourselves. I'll explain that later. What it means is that if you see that married put where we opened Texas Instruments at 58.05 and we bought the 60 strike put for 540, you might have looked out 1 or 2 weeks from May 16th when the position was open and said, I'm going to go ahead and sell a 59 call right now because I want to start generating premium against it. If you apply income method number 1 incorrectly, if you sell the call too soon, you sell it below the put strike price, now you're trading against yourselves. Buying the married put is not trading, buying the put, excuse me, is not trading against yourself. Yes, I'm bullish on the stock, but I'm ensuring an investment. That's smart trading. That's not trading against myself. The minute I try to force selling a call too soon, I'm actually going to create a bearish position where now I'm trading against myself because I was looking for a bullish stock. The con of income method number 1 is we're going to cap the upside, just as you do with a covered call, but there's an income method that can counter that as well. Jay says, can you show an example of a rule not to buy the put around 20% in the money? If I have time at the end, Jay, I will. That was discussed, about 8 to 10 minutes of that was discussed in the previous webinar of setting up the RadioActive Trade and why use a RadioActive Trade and why we set it up the way you do. So I'm not going to spend too much time on that today because I'm going to go forward of what is possible. But at the end of the presentation, Jay, if I have time, we'll run an example of why I would not be in such a good position by going more than 20% in the money. All right, so I'm going to pause for a moment here, and we're going to go ahead now and navigate over to Power Options. These are the tools, of course, we use to apply these techniques. And I'm not going to do the trade comparison now. I'm just going to go ahead and take a look at our Texas Instruments married put position. And I'm going to go to the profit and loss chart. Prices might have changed from when I looked at it about 20 or 30 minutes ago, but that's okay. What were we just talking about? We were talking about income method number 1, selling a call against the position. Here's our married put. Once again, our RadioActive Trade with the cost basis of 63.45 and the at risk of 345. Stock is still hovering around 61.49 right now, 61.50. Now that I've waited for the stock to move up in price, it would be a good opportunity to maybe apply income method number 1. So let's just take a look. What are my choices here? Well, first, for those of you that are using Power Options, you know that at any time, as you're tracking any position in the portfolio, whether it's a covered call, a married put, maybe a credit spread, we can go to the Position Actions menu and go to Position Analysis. The position analysis gives us a breakdown of our current position. There's our 3.4, 3.8% gain after 29 days. And if we held it all the way to expiration, we'd only lose 3.1%, assuming we did nothing else. Now the tool shows us some opportunities for applying income method number 1. And we have various choices we can do. We could go right out to close to 30 days out in time with the July weekly series. We could go just 17 days out in time and take our risk down from 5.4% down to 3.8% and so forth. Okay, so this gives you a guide of potential opportunities, and we're doing all the heavy lifting for you. Now with a stock at 61.48, 61.49, let's call it 61.50, I know, and following the rules in the blueprint, I'm going to be looking at selling maybe this at the money call, the 61.50, the 62, or the 62.50 strike. Okay. Well, without getting too deep into the different choice selections and everything along those lines, that's what's going to be discussed Thursday for a members-only presentation on the 12 different income methods. Let's just go ahead and say that 17 days out, we could sell the July 61.5 call for $1.05. All right, and what would that look like? Well, I can simulate the trade and see things graphically. Okay, so here's an opportunity. My current position is on the left in red, where we know we have a current gain of 3.4%. And on the right in blue shows us our new position if we sold to open the July 1st 61.50 call for $1.05. We'd, of course, take our risk down to about 254 on the position. We lower our risk down to 4.1%, and we have a maximum return now for 17 days out of 5%. But just like selling a covered call itself, the gain is capped. Why is the profit falling off for income method number 1 if we see the stock go up to $63, $64, $65 per share? It's because, just as we see with a covered call, we've capped the gain in the stock. So if the stock continues to move up in price, we don't get any more advantage of gain past 61.50. Essentially, the delta on the call just goes to 1 at expiration on July 1st. So if the stock's at 64, it would cost me $250 to buy to close this call. I missed out on the upside opportunity, but our other asset, our put option, is still losing in value. So why is it important to have the blueprint and have the SIGA model? Because this shows me right here, this profit and loss chart, and the Power Options tools help us apply the SIGA model to our account. I would choose this income method if between now and July 1st, my expectations were that the stock would continue to trade around $60 or maybe $63 per share, more in this kind of range. So I could maybe adjust this with income method number 2 if it goes up to $62 or $63. If it falls down, hey, I can let it expire and I can look to sell maybe the 60 call or another 61 or 62 strike call going forward. The profit and loss chart here you're seeing in the simulate trade function on Power Options is helping you apply the SIGA model. If my expectations are the stock's going to continue to move up in price, would I use income method number 1 right now? No. I'd use maybe a 6, or maybe I'd use a 4, or a combination of the two. Let's go back to the position analysis, and you see other income methods here. Well, here's one for income method number 4, where we could roll the put up in price, okay? And we see an opportunity for income method number 6 as well. What I want to do now is look at some manual adjustments for this Texas Instruments position. I like the 4 idea. I like the 1 idea to generate premium. And if I wanted to leave the upside open, I'd consider 4 or 6. But I'm going to show you all 3. I'm going to show you putting that into practice. Let's go back to our profit and loss chart for the original position. We saw already what I might choose to do by selling the July 1st 61.50 call. If I wanted a little more upside, sure, I might choose the 62 strike or the 62.50. Let's, for example, go out to standard expiration for July. And let's go ahead and simulate income method number 1 again. Now, because we're further out, we do have weeklies, but this hasn't transferred over to the weekly strikes yet. As we get closer to July 17th, we know that these positions will start to see the 61, the 61.50. But for about the same premium, about $1.05 or so that we got for the July 1st 61.50, I could sell the 62.5 call for about $1.10. It's $1.08 to $1.10, so let's keep the math simple and just call it $1.10. So on our profit and loss chart, our custom spread tool, we'll go ahead and put that in. Question came in that I expected, is that why would you sell the 31-day out call at a higher strike for 110 instead of the weekly one where you can get about the same premium? Honestly, if I did think that Texas Instruments was going to stay around 61, between $62 and maybe $61, I would sell the July 1st. I'd get a better premium as far as time value, meaning that I could sell that 17-day out option maybe twice in the same time period that I can sell the 62.50. I'm just trying to keep it simple with standard expirations. Okay, so here's about the same, because we got about the same premium, here's about the same risk-reward chart that we saw. We have a higher potential return because we went to 62.50 instead of 61.50. The risk is lowered to about the same. But what if I thought the stock might continue up? That I didn't want to cap my upside, that I think maybe the stock might trade in a range, but if I feel the market might be strong and it continues up, what else can I do? Well, this would be income method number 6. It's one of the riskless spread trades. And what I'll do with income method number 6 is once I've sold the call, I can now go ahead and buy a higher strike call, let's say the 65, and we're going to call that 30 cents. So now instead of taking in 110, I'm going to buy the higher strike call for 30 cents. We're only going to take in 80 cents. So the risk is not going to be reduced as much. But now if the stock continues to move up, we leave the upside open. And notice at the same time, the halfway point on June 30th, we have something that almost looks like just a straight stock position, but we know we've limited the loss to 4.2%. Okay, so this essentially is income method number 6. What is the advantage over income method number 1? Well, obviously it leaves the upside open. We take a little less premium, but we still reduce the risk. I'm still in a better position if the stock collapses. And if the stock gaps up for some unexpected reason or the market's really strong, I've left my upside open. So again, based on my expectations, that would determine whether I'd use income method number 1 or income method number 6. Now, is this a bear call spread? Absolutely. I sold the 62.5 call and I bought the 65. Why is it a riskless spread trade? Well, it's a riskless spread trade because it's done in the proper context. If I just open a bear call spread for Texas Instruments, selling the July 62.5 call and buying the 65, yes, I still take in 80 cents of net credit, but now I'm risking 170. It's a little bit more than a 2-to-1 risk-reward ratio, which is fantastic for a credit spread, and I'll show you that in just a minute. But at the same time, although I could make 47% if the stock gaps up, I have to put up the margin for this 170 to cover the obligation. Income method number 6, the bear spread, done in a context of a radioactive trade. We bought 100 shares of Texas Instruments at 58.05. We bought our January 60 put for 540. We don't have to put up the margin requirement because our broker just sees this as a covered call. with an extra long call on top of it. So we get unlimited upside. We don't add any more risk to the position. In fact, we lower the risk on the position. We're in a better position, and we still have unlimited upside. Question comes in from Robert, said, would you sell 2 of the 62.5 calls sometime? No, I wouldn't. But income method number 5 does do a ratio spread. I wouldn't sell the lower one twice. I might actually sell 2 higher ones and buy this one at a net credit if possible. That's a different income method as well. So no, I would never sell these 2. Right? It just doesn't match my risk-reward tolerance, and that's why it's not one of the income methods. Let's take a look. What happens there? Your risk drops to 2.4%, but now this steep gap is higher. Remember, I was using income method number 6. I thought the stock would continue to move up. Here's a very tight range, and now I have a covered call with a bull call, bear call credit spread added to it. So this is not an approach that I use because it doesn't match my expectations. Better risk-reward profile shown with income method number 5, and we're not going to look at that today. All right, now, that's an example of income method number 1. I gave you 2 income methods already, income method number 1 and income method number 6. Joe asks, is there a recording? There will be a recording. We'll probably email everyone around 5 p.m. Eastern Time when the webinar is posted. All right, now, I want to go back again to our slide presentation. And let's talk about something else. That was a simple adjustment, okay? And even though I might have made things look complicated by adding that extra leg to apply income method number 6, at the same time, the SIGA model and the blueprint would have dictated why I would have chose one over the other. But let's talk about something else. Here we talked about generating time value by applying the at-the-money bell curve. Now I want to talk about manipulation of time value. When you set up the RPM correctly, it puts time and time value in our favor. The time value of the insurance can be manipulated, it is an asset that we bought. It's not something I just threw money away into, or like I pay insurance on my car month by month because I want to have insurance on my car in case the unexpected happens. I want to have insurance on my home in case the unexpected happens. But there's not a lot I can do with that insurance that I'm paying monthly or every 6 months or every year, okay, unless something happens. The put is an insurance policy we bought on our stock that can be manipulated. Remember, when we bought the put option, when we opened the married put, we paid $5.40 for that put option. The stock was at $58.05. We bought a 60 put, so $1.95 of this $5.40 was time value, extrinsic value. Or I'm sorry, it was the intrinsic value. Wow. All right, let's try that again. The put was $1.95 in the money, so $1.95 of that $5.40 was intrinsic value. We were guaranteed to get that back no matter what happened. The $3.45 was the extrinsic value or the time value, and that was our true risk. We're not risking $5.40, we're only risking the time value. But as we saw, the put option is now out of the money. Our stock has moved up to about $61.50. The put option is currently at $4.30 at the midpoint. It was about half an hour ago, might be a little bit less now. So that applies the at-the-money bell curve. When we buy options in or out of the money, we pay a lower time premium. If I buy them in the money, I'm paying intrinsic, but I have a lower time premium. As the option becomes at the money, the extrinsic value, the time value, even though time went by, the time value increased. Okay, this put option is now all time premium. It's out of the money. The $4.30 is entire time premium, and when we opened the position, it was only $3.45. So the at-the-money bell curve gave us the opportunity where our time value actually swelled and increased as our put option went from in the money to at the money, a little bit out of the money now, still close to at the money, and we can use this as manipulation to lower the risk on our position and generate income perhaps. Let's talk about that. I'm going to pause the screen once more. Let's go back to power options. Let's go back to our married put position on Texas Instruments as well. All right, so let's go to the profit and loss chart. We saw an opportunity for income method number 4. Now that the stock has moved up, I can sell to close this asset. So we'll go now to January. Let's take a look here. Now it was at $4.30. Okay, but the stock moved up to $61.57, so let's say that our time premium here is about maybe 415 or 420. We'll keep the math simple. We use 420. 415 is more likely, but let's go ahead and use 420. So I could sell to close that asset now for 420. What does that mean? It means I've lost 80 cents on the put on a stock that's moved up $3.52. Okay, really only lost about 80 cents, haven't I? But now this put has dropped, so is the 62.50. Okay, so I can sell to close this put. Am I losing $1.20? Sure, but now I'm going to buy a put that's at a higher strike. I'm going to get in 420 into my position. I've already paid for this, so it's already accounted in the 63.45. We're going to lower our cost by 420, and let's say we're going to pay 540 midpoint here to buy the 62.5 put. Same price I paid, so now I've got 1080. If you think about it, I've got 1080 in extra costs in the position and generated 420 against it. So how am I not adding to the risk on the position? Check this out. Our risk now has dropped down to 3.3%. Income method number 4 is really the only income method that's done at a debit. But why did I say that I'm generating premium, in a sense, and putting myself in a better position? Well, we've lowered our risk from 5.4% down to 3.3%, from 354 down to 215. How is that? How did we manage that? Because we added more cost. We paid a debit of $1.20 into the position. But remember, I increased my guaranteed exit by $2.50. So essentially, I gave myself a $1.30 advantage in the position. Did I increase my cost basis? Yes. But the increase in the strike prices was greater than the increase in my debit. So we've lowered our risk by that $1.30, difference in the strike prices minus the net debit, to only $2.15 or 3.3%. Okay, that's better than what we saw with income method number 1. But we were talking about maybe selling a July 62.50 strike. Okay, we wanted a call that was sort of at the money and above our put strike price. Now that I've moved the put up and taken my risk down to 3.3%, what have we done? We've lowered the risk, we've left the upside open, and we get a better profit and loss curve on the halfway point of October 4th. We've increased the potential profits if the stock goes up to 62.50 because, again, we're not down 540. We're not down the 1080 we paid for both puts minus the 420 we received, so about 660. I'm not down 660. I can only lose 215, and that's in the worst case scenario. Again, if I hold the position all the way to January expiration, somehow choose not to accept any dividend payments and apply no other income methods. But I could, of course, combine income methods. And if I decided now that I've lowered my risk to 3.3% using income method number 4, by the way, that's not 2 commissions. If I decided to roll this leg, I would just enter it as a roll, selling to close the 60 that I already own, buying to open the 62.5. So let's go to July. Now that I've rolled it up, why not sell the 62.5 call again for that 110 premium? We've already reduced our risk down to 3.3%, and now I can go further. And now we have a risk of only 1.7%, and we increase the max upside return at 62.50 for July expiration at 5.6. The market odds are now greatly in our favor. Instead of a credit spread that you open, where you may be looking to make 50 cents and risking 5, you've got a 9-to-1 or 10-to-1 risk-reward ratio to try to find that 80% probability of expiring worthless. I now have the potential to make 5.6%, and the worst I can do is 1.7%. Okay, and we also talked about bulletproofing, manipulation and combining income methods sort of internally, mentally. Also discussed in the blueprint, there's a full chapter on combining income methods. I could bulletproof this position right now. Okay, how could I do that? Very simply. We're going to sell to close that 60 put again, but I can manipulate time value in 2 ways. Number 1, when we rolled the put up, we're taking advantage of the increase in time value that we have on our now at the money put. We're buying a deeper in the money put that has lower time value. The stock's at 61.57. Remember that January 62.5 put was priced at about 540. But roughly $1 of that is intrinsic value that we're guaranteed to get back from where the stock is right now. So the 440 is time value, but we gained most of that back because the 95 cents increase in time value of where we originally started. But let's say I wanted to roll the put up to lower the risk. I've got a January put that's 220 days out in time. What's another way to manipulate time value? What if I move closer in and up? Okay, so how about we buy the 62.5 put for October now, right about $4. Now I'm actually doing a roll for a credit, and I'm keeping my guaranteed exit at 62.50. Okay, so we sold to close the January put for 420, bought a closer in October 62.5 because the stock has moved up. We want to stay in the money for $4. Now I've dropped my risk down to 75 cents, 1.2%. I still have protection out to October, which is still 129 days away. Right, we're still 4 months out in time, almost 5 months out in time. Well, not really 4.5, let's call it. And I have a very minimal risk on the position. But hey, I just applied one income method to reduce my risk. I still have unlimited upside if my expectations for Texas Instruments are that, let's say, in the next 17 to 20 days, the stock's going to be trading around that same price, maybe around 61.50, 62.5. Why don't we go back to that first one we saw? Go to July 1st. It's a lower price, but look, bid of 70, ask of 91. So it's a 21-cent bid-ask spread for the July 62.5 call. So maybe we can get 80 cents for it using the midpoint. Now what has happened? Still have the chance for a 5.4% gain, and that'd be 17 days from today, so we'd be in the position for 47 days. That is a very good return, probably higher than what you'd expect for most covered calls, cash secured naked puts over a 45-day time period. And now I have a negative at risk, meaning this stock could collapse 50% of its value. I'm still guaranteed a profit. It's a small profit, but that's bulletproofing. I now have no risks to the downside, and the stock can continue to move up in price. I can also adjust this at any time. Let's think about it this way. What happens at July 1st if the stock stays around 62? Our call expires worthless and we keep the 80 cents. We'd reduce the cost basis on our stock, right, from 58.05 down to 57.25. And we still have all our other put transactions. So what do we have now? On July 1st, the call expires. Stock's still trading around my range. I could choose to sell another 2-week out call for maybe 80 cents or so and have a guaranteed profit to the downside of $85, with probably closer to a 6.3% gain if the stock's trading right at 62.5. But here's a bulletproof position, and let's just take a look real quick at the stock research tool. So July 1st I'm bulletproof, and July 25th, sometime around there, is when the next earnings is. So if I sold another call, or I generated another 50 or 60 cents against our position for the July 17th expiration, we take our cost basis down from 57.25 down to, let's say, 56.65. We'll go 60 cents in that case. Now we're guaranteed a profit of 1.1% going into earnings, wherever the stock is. If the stock collapses, drops 20 to 30% because of poor earnings, I'm guaranteed a profit on the position. And if it gaps up, I still have advantage to take unlimited upside profit potential, or I could play other income methods going forward to put myself in a better position to profit if the stock falls or moves up, or increase my expected profit if the stock moves up 2 or 3 points, maybe about 5 to 8% at earnings as well. Some of the different nested spread trades or income method number 12. Again, depending on my current conditions of the market and of my position, my expectations going forward, and my goals for the position. How many times have you been in spread trades? Have you been in covered calls? Have you been in cash secured naked puts? Or maybe even a collar that offers you maybe a 3% upside gain or maybe only a 6% loss going into earnings, and what was a profitable trade became the 5.86% loss in the collar, or you ended up losing 25 to 30%, maybe unrealized on the covered call, but if you're generating 2% per month, that means it's going to take you 24 months to get back to where you were. How about going into earnings with no fear? Knowing that you're still guaranteed a profit. Is it a great profit? No. I mean, after maybe 50 days, I'd hope to have a profit of 3 or 4%, usually averaging about 1 to 1.5% per month. That's my goals for the radioactive positions and what I've been able to meet over the last 6 or 7 years as well. Okay? So, but this gives you that opportunity. Think about this. If I did a covered call on Texas Instruments beforehand with a stock at 58.05, how long would it take you to cover the total cost of $57? It might take you up towards about 40 months, generating $1.50 or so. Here, you have the guaranteed payout. You've got the limited risk position, and it was only really 2 adjustments. We rolled the put, and then we sold the call, and then we might sell another call later on to get in this position. That's 3 adjustments in a 2.5-month time period. Why am I pointing that out? Is because although it seems maybe complex, that's why we have the blueprint. That's why we have the free help to help you along with the income methods and discussion of when to apply a different income method for blueprint owners. And then the Fusion subscription at RadioActive Trading has timed lessons which walk through the ins and outs of the 12 different income methods as well. Okay? But I'm pointing this out because sometimes we have covered call investors, and that's fine. You know, everyone has their own strategies, but they say, oh yeah, okay, so I've been able to cancel the risk on my position completely. Well, okay, so they did it. How long did that take you? About 2 years. In the right scenario, you can cancel all the risk, still have 4, 5, 6 months of protection in place, and we did this all, potentially, in a 35 to 40-day time period. I can still collect dividends as well. That's the other thing. Texas Instruments pays a dividend. Their next dividend is coming out after their earnings, probably around July 28th or so. And it's about a 2.5% dividend or 38 cents per quarter. So a little cheat. That's income method number 10. We decide to do that when you open an RPM or not. Okay, it's deciding to choose a stock that pays a dividend to help the returns. I've already collected 3 dividends on Texas Instruments. And yes, my position in the Fusion subscription on Texas Instrument is bulletproof, and I still have insurance out to, I believe, October on this position as well. Actually, no, I'm sorry, this one's July. This one's July, so it's not going through the earnings date, but it has a high profit, and it is bulletproof, and I should be able to collect the other dividend, and I may do an income method to go through the next earnings as well. Okay, so what I did show you there was the opportunities of income method number 1. We showed a quick example of income method number 6. We showed applying income method number 4 in combination with 1, and maybe with a twist, rolling it in time as well, which is income method number 3. But why would I use one over the other? When would I know when to use one over the other? That's what's described in the blueprint for each of the 12 income methods that are discussed. And someone mentioned, well, I thought you said that there were 13 income methods. There are. The 13th income method, of course, is do nothing. If I look at a position and I want to maybe make a trade where I'm going to apply a different income method or adjustment, and I have one in mind, it doesn't show up on that position analysis screen, and I evaluate it on the custom spread tool, if it doesn't match my SIGA model, I mean, many of us could say, okay, well, the stock's not up where I want it to be, but I could sell a call now. Well, if I look at that profit and loss chart and it doesn't match my expectations or my goals, or worse, a lot of times I see what happens is trying to force that income method increases the risk to the upside in the direction you thought the stock was going to go. That's trading against yourself. And I'm going to show 2 quick examples of that in about 5 minutes, but first I wanted to review some other things as well. I've spent a lot of time today discussing what is possible. Okay, we showed that the married put itself could be liquidated for a gain of about 3.5% or $224 right now. Remember that when I opened the position, we had a quote-unquote break-even at expiration of 63.45. Okay, But the stock's only at 61.49 and we're already at profit. Why? Because we set it up correctly to begin with. How does this compare to the other sexy option strategies? Well, let's take covered calls. I've got two examples here for you. If on May 16th, we were looking at Texas Instruments trading at 58.05, I could have sold the 17th June, about 32 days out at the time, but the 17th June, this week's expiration, 57.5 call for $1.70. Now that would have given me a reasonable return of about 2% if assigned, and remember the stock is at 61.77, so we're $1.50, $1.60 in the money, but I'm still risking 56.35. Did I reduce my cost basis, have a downside protection by roughly 2% or so, by $1.15, really the $1.70, so it's probably closer to about 3%. Yes, we would have had a 3% downside protection. The stock fell 6%, I would have had a 3% loss. On the married put, if the stock fell 6%, I'd probably only have a 1 or a 1.5% loss on the position. If the stock fell 20%, well, we know what would happen there. You'd have to roll down the call and try to hedge that loss. I can't lose more than 345, and that would only be at January expiration. Now, this is an in-the-money call, of course. If you wanted to go with a better downside protection and still have a reasonable 2% return for about a 30-day trade, you would have gone in the money. And right now, your position could be closed for a profit, of about $89 or 1.6% for the covered call. If you bought back the call now with still the time value remaining, well below what I have in the married put position. At the same time, let's say you were more speculative. You went ahead and you did open Texas Instruments at 58.05 and you decided to sell the out-of-the-money 60 call for 53 cents. Well, now you take in less premium, so you only have about a 1.5% downside protection. You'd be at a profit right now of about 4.3% or $248. But now you have to decide, do you take that? Or do you pay more money into this June 17th call? So it's about a 50-cent difference there. So we're going to call it $1.65, $1.67 buyback cost to close this position, to roll the call first. But let's take a look. So now I've increased my cost basis up to 59.17. And I say to myself, okay, well, the stock's at 61.77. So again, if I go to July and sell the 62.5 call now, it's up at 113, but we're going to keep the 110 we saw in the other example. So here's your call rolling position. You could make 7.7% if the stock stays up, but you're still at the high risk. You haven't controlled your risk on the position. If you add a put now, you're going to take this down to maybe a 4% profit, maybe only be risking 6%, but remember, we are looking at a 5.8%. A question comes in that we're probably going to answer on Thursday. Robert says, suppose the stock collapses right after you buy it. Do you close the trade or do something on the put side? Any income methods on the put side? Sure. That's what we're going to discuss on Thursday for the members-only presentation. We're going to talk about different scenarios. The stock moves up, stock moves down, stock stagnates. What can be done? For my ideas, depending still, Robert, on my expectations going forward, there are, I'd say, 4 things that I would do after the stock collapses. Okay, there are potential for 4 different things if the stock collapses. Yes, I can manipulate the put. Yes, I can do another income method. I can do an alternative income method. I can close the trade as well, or I can combine a couple of income methods. There's a lot of opportunities that I can do there, but it depends on my expectations going forward. And I'll just say quickly, if my expectation is after the stock has fallen, Robert, and it fell from something that maybe wasn't related to earnings, because we know that if the stock recovers, I can stay in the position and still have the upside because I had the limited risk in place. I can manipulate my asset, as we talked about as well, to lower potential losses on the position doing different income methods or combining income methods. But if it's something happened that was more related to the stock and not to earnings, meaning just they're completely now, it comes out that they've been mismanaged, that they've lied about their past earnings, they did something manipulative to their numbers. If I don't think the stock's going to recover, yeah, I might just close the position, take a 6% loss. That same position, had I opened it as a covered call and the stock collapsed, remember you're at an unrealized loss of maybe 25, 27, 30%. I'm still looking at an unrealized loss of only 5 or 6% with the proper technique. All right. Now, one last thing. Bullish positions. This was a bullish stock. And I can say, someone did mention, you would do better with bull put credit spreads. Yeah, if I could consistently pick stocks that moved up. And we showed on Thursday's webinar the trade simulator tool at RadioActive Trading, which shows you what is possible if you take on a bull put credit spread risk where you're looking to make 11% if you're right, but you're risking maybe 50%, 60% even with stops in place on the leverage spread trade. With that setup, you need to be right 90% of the time to profit long term. So if you're finding positions that have a 75, 80% probability and you're right only 80% of the time, you can actually lose money on spread trading. Same with covered calls. Eventually, even if you use a stop order of 7 to 8% or a trailing stop, eventually you're going to hit a loss of 15, 20, 25% from an unknown event. And what we saw with that, if you're expecting a gain of 3% when you're right and 7% when you're wrong as your stop order, even if you're right 75% of the time, well, I should say even if you're right 70% of the time, you might not make any money on a covered call portfolio. You have to be right closer to 75, 78% of the time to profit with that risk-reward ratio. Meanwhile, if we control our risks to only 4 or 5%, and I still make, which I do on average, by the way, is about 5, 6 or 7%, earnings about 7%, I'm at about 5.5% on my winners. But even with that win-loss ratio, if I'm right only 50% of the time, I will still make money. This is the only strategy I know where you can actually potentially be wrong more often than right and still make money. That's the other possibility as well. So I pulled up 2 credit spreads. Jay, I'll show you that in a second. Why does Ernie do better? It's 2 different variances, 2 different variables. Now, I wanted to show you 2 things here. Here's a bull put credit spread. Same date that we would have opened the married put. And with a stock at 58.05, most of you might not open a bull put on a stock like this, but with Texas Instruments at 58.05, we could have sold the June 17th, this week's 57.5 put for $1.15 and bought the 55.50 put. It should have been 55, I apologize, but that's okay. The 55.50 put for 47 cents. Right now, if I did 5 contracts in that position, I know my net credit initially between these two would be about 70 cents, it'd be about 68 cents or so. But if I did 5 contracts, my maximum profit is $3.40. But the risk of $2 between the strike prices, okay, that would be a risk of $2.20 or $6.60. Okay, so again, that's a 2-to-1 risk-reward ratio, and this looks like a great return. And again, today, assuming the stock stays above 57.50 through June 17th, we'd make a profit of $338 doing 5 contracts, taking the reverse ratio, a 2-to-1 risk-reward ratio on our position, and we could have a 51% return. However, I want to point out that that spread is unrealistic. Is it realistic that we could have entered that bull put credit spread with those prices? Yes, but most of you who do spreads would not have chosen this position. The stock at 58.05, even though it offers a 50% return, the probability was only 55% that the stock would stay above 57.5. Most of you doing spreads would have gone the other way. Instead of opening a bull put, selling the at-the-money 57.5 and buying the 55, you likely would have sold to open the 55.50 or 55 strike and bought the 52.50. You're still taking in 47 cents, but you're going to pay 20 cents out. So now you're looking to make a maximum of about 27, 28 cents on a risk of about $1.70. Or with 5 contracts, looking to make 140 to risk 1360. That's the 10-to-1 risk-reward ratio. If Texas Instruments did the opposite and fell below 52.50, highly unlikely. Okay, even dropping below 55 had a very low probability of occurring. But here's that 10-to-1 risk-reward ratio, and again, 28 cents, 5 contracts even, so we keep the risk, which is 3 times, almost 4 times what I had on the married put monetarily in my portfolio, but to make $140. Okay, that's the most we can make, is that $140. Here we're at 224. Okay, so again, I just want to show you those comparisons related to what happens with the stock, what is possible with the married put in comparison to these other sexier strategies of using leverage or generating premium month by month or week by week. You can still see the benefit of the position, of course, and remember, with the married put now, I have multiple choices to adjust the position. If I want to generate income and leave the upside open, I have income methods that could do that. If I want to lower the risk and leave the upside open, I have choices for that as well. If I want to lower the risk and reposition the married put so I can profit if the stock now falls back down to 58 or moves up to 65, I can do that as well. That's what's available in the blueprint. That's what we talk about with the 12 different income methods. Now, okay, so what was the one question there? Okay, let me go back. I'm going to show two things very quickly as well. Okay, Jay's asking a lot of questions here, but that's fine, Jay. If you're bearish on the stock, is there an income method? Yep. We have a full webinar for Blueprint owners. It's available on the website that talks about how Kurt and I approach the radioactive limited risk techniques if we think the market is bearish. There's multiple ways to do that. If the stock falls from when I opened it, it goes against my expectations. I already showed you in one of the beginning slides, there's different income methods that can be used if the stock moves down in price. And we talked with Robert just a little bit ago, what happens if the stock gaps down suddenly after you open the position? Yeah, I've got choices to manage that as well. So whether I'm approaching it as straight bearish and I want to sort of switch the techniques to look for bearish stocks, we've got approaches for that. If the stock falls against my expectations, I've got income methods to do after that as well if I've already bought the stock from a bullish position as well. All right, very quickly, I'm going to show two quick things here. I'm going to go to just married put, and I'm going to go to search. The search tool here on Power Options shows us the default radioactive trading parameters and the positions that come up that match that criteria. I'm going to take Viva Systems here because I want to show two things. Number one, let's look at the profit and loss chart of this position. For this stock right now, which is actually one of the that Greg's in the Fusion portfolio that investors can follow, is he bought the stock at, well, right now I could buy the stock at $34.14, buy the December 36 put for $5. This would give me a cost basis of $39.14, and I've got a risk of 8%. This is higher than I usually like to take. Now, I've got a stock at 34, got the 36 put. Let's take a look at the options that are available. We have standard expiration, no weekly, so I'm going to go out to July. And there's a 34 and a 35 call. So let's say I want to generate premium right now, and I want to sell 35 call. We're going to say we get 80 cents for it. My risk is $3.14, so generating 80 cents is about a fourth of it. I'd really prefer doing income method number one, talked about in the blueprint, to get a third of my initial at risk. But let's go ahead and say we sold that 35 call right now for 80 cents because we want to try to lower our risk immediately. Now remember, my initial at risk is $3.14 or 8% to the downside, and I have unlimited upside profit potential. By selling the call too soon, and especially below the put strike price, which is also a no-no discussed in the blueprint, we see two things here. Number one, my risk increased. How is that possible? I generated 80 cents. My risk should have dropped from $3.14 down to $2.34. Well, it did to the downside. But now the risk increases to the upside because we forced an income method too soon and we sold a call well below our cost basis. So now, in the direction I thought the stock was going to go, I increase my risk. That is trading against yourself. That's why you don't sell a call right away. You don't do income method number one right away, and you don't want to sell it below the put strike price. Also, in the best case scenario, the stock's trading right at 35 with this position, we'd only make 61 cents or 1.6%. Okay, I had higher expectations when I opened a married put, as we mentioned. I'm looking for a stock that's going to grow maybe 4 to 8% in the first 20 to 30 days, as we saw with Texas Instruments. Now, of course, we already talked about why we're losing money is because we capped our gain at 35 and the stock continues up. I get no more advantage of the stock and I'm losing money on the put. That's why we don't do that too soon. Let's take a look at something else here. If the stock moves up to 36, it moves up $2, okay, around that 6%, 7% I was expecting to move at the July expiration. Okay. And the covered call here, as the stock moves up to 36, or adding the short call too soon, the stock's at 36, our expected profit would only be $13. But if I take the call out of the equation, and I say, what would happen in 30 days if the stock was trading at 36 with just the married put? And of course, we go to the July 17th expiration here. July 15th, was it? Yeah. All right, so now, still not great, but I'm making $33. I'm making double, in this case, what I expect to make by selling the short call too soon if the stock moved up to 36, which would probably more match my expectations. So this is the idea about trading against yourself. Buying the put is not trading against myself. I'm not 540 down. I'm not behind the 8 ball when I open that position. I'm at the right place at the right time, and I bought an asset that I can manipulate better off. Going back to Jay's question, what about going more than 20% in the money? I'm going to go to the search by symbol tool. You see that I'm going to show all results for Vive, Viva Systems. Well, it's probably too much. But here's the December series. Blueprint teaches that why I want to be in this range. Okay, why do I want to be under 20% in the money? Sure, if I go higher, let's say I go to the 45 strike, which is 32% in the money, I could have a risk of only 2%. We could have a risk of only 1.3% by going up to the 50 strike, which is 47% in the money. Why not do that? Is because now your expectations of profit are extremely small. It's a trade-off in every form of trading. And this, by the way, everything I'm talking about here today, the proper setup that we talked about on Thursday, why we use the proper setup, why don't we sell a call right away, why do we use the different income methods, and why do we have the rules to apply them, is based on Kurt's 12 years of using this technique and figuring out what works and what doesn't, and my enhancements and Ernie's enhancements and customer enhancements who've been trading this technique for 7 to 8 years. Okay, so that's why we have these rules in place, because this is why investors get into trouble. Going deeper in the money is going to give you a lower risk, absolutely, but now you have a much lower expectation of profit, and unless there's a very, very large move, you end up not being able to do the income methods correctly, and you'll start trading against yourself. Okay. Very quickly, I'm going to go to RadioActive Trading. I'm going to go to the track record here. I just want to answer Jay's quick question again. Why does Ernie do better? Let's first look at Ernie's risk-reward gains that he's shown. Ernie averages about a 10.8% on his closing winning trades, average gain on winners, and a 4.8% loss on his losers, and he's correct less than 50% of the time. Why does he do better? Because Ernie has a tendency to stay in positions longer. He'll continue to trade a position to get to the profit or to get to the limited loss he wants to. So he'll stay in positions a longer period of time and keep applying the income methods. I don't. Okay, I'm rarely in a position longer than 7 months, very rarely even that long. Okay, let's go back to my track record here real quick, and these are all the trades that I've opened and closed in the Fusion portfolio that investors have been able to follow for the past few years. Now, excuse me, folks, I average only a 7.2% gain when I'm right, 4.7% when I'm wrong, but I keep my married puts around an average of about 180 days, and I've been lucky that I'm right about 60% of the time, meaning I'm showing a profit, whether it's 1%, whether it's 0.5%, whether it's 58.9%, which I had with the silver wheaton married put a few years back, 20 or 15% with Johnson & Johnson or so forth, but the average gain is 7.2, lower than Ernie's. Average risk is about the same, but I am right more often than wrong, and I stay in positions of less time. This, again, illustrates why is there 12 different income methods? Why are there different ways necessary to manipulate a position? Because it's also not about picking the right income method. Because as I mentioned, you can pick any income method. You know, if the stock moves up, I had the list of income methods you could choose. You're still going to put yourself in a better position than when you were. All right? And that's the idea, that every investor has their own risk-reward tolerance. And Jay, you and I might be in the same position. The stock moved up. Your expectations might be the stock might continue up another 1% or 2% in the next 15 days, and I might think that the stock's going to stagnate or pull back over the next 15 to 20 days. You and I would choose different income methods on the same position we'd both be in a better position. We both would have lowered our risk. If I'm right on my expectations, I might do a little bit better. If you're right on your expectations, you might do a little bit better. It's always better to have multiple tools in your toolbox rather than one or two means of adjusting, like we see with the covered call or spread trades, or missing out on further profits going forward. Okay? Now, where can you learn all 12? The only place to learn all 12 income methods in the SIGA model for each one is in the blueprint. Okay? So over 250 pages detailing step by step that initial setup and when to apply the 12 different income methods, a full chapter on combining income methods, and more in the appendix as far as case studies and things of that nature. You also, of course, receive full help. Any blueprint owner can call RadioActive Trading or Power Options at any time, schedule a coaching session. We'll answer any questions that you have. We can discuss positions and walk through the math with you as well. Now, what is available with the blueprint? Is it just, hey, buy the blueprint and you're out on your own? Absolutely not. Right now, of course, if you pick up the blueprint, you can take advantage of the various bonuses that we have. You can see these bonuses at radioactivetrading.com/iridium. I'm sorry, that's wrong. Sorry. Take this out. Take that M out. I'm sending everyone the link as well. It's IRIDIUM. radioactivetrading.com/iridium. Okay, and I'm sending everyone that link correctly. There it goes. Yeah, I got that taken care of, Bill. Thank you. So it's Iridium, and I sent everyone the proper link as well. All right. So what else do you get? When you order the blueprint, Kurt's going to send you something called the Quick Action Guide, which is going to help you get started radioactive trading more quickly. You don't have to digest everything to maybe start right away. Kurt put together 6 Mastery Series CDs. These are about 2-hour-long presentations which go more in depth. Well, they don't go more in depth, but they show different examples of how to manipulate the position. It goes through the different income methods. The Fort CD is the Foundations of Radioactive Trading, kind of covers chapters 1 through 3, but in a visual format, like a webinar like today. Next disc is Income Methods, the Beginnings. It talks about 1 and 2. Profit with Puts, we saw some of that today. It talks about income method number 3 and 4. Money Nets is income method number 5 and 6. But if you pick up just the blueprint today, we're going to send you one of those 6 Mastery Series CDs for free, the Foundations of Radioactive Trading, which is an $89 value. I showed the Fusion trades a moment ago. Okay, the Fusion subscription allows investors to follow along with the radioactive trades that Ernie and I put into my personal account, as well as Greg. You can review Kurt's track record. There's also lessons in the Fusion subscription to help you master the radioactive trading techniques as well. It comes with full support. There are also tools for identifying new RPMs. It's called the RPM report. It's a basic search screen. But as a bonus for buying the blueprint, you can get your first month of Fusion for only $10. It's usually $69 per month. And all the tools I showed today on Power Options, running the search, changing the search criteria, tracking and looking at maybe income methods or rollout opportunities, so you're tracking positions in the portfolio, and of course using the custom spread tool, you'll get a free month of Power Options. If you're already on a trial, we'll just add an additional 30 days to your trial to Power Options. And of course you also receive, trial members and subscribers can also receive that free coaching session, and you could have multiple coaching sessions after the initial coaching session as well. That's what's a bonus available if you pick up the blueprint. In addition to that, what are the other bonuses? The blueprint or the home study kit, which contains the blueprint and all 6 Mastery Series CDs, does come with a money-back guarantee. If you pick up the blueprint, you start going through the content, and you just feel it's not for you, and you just feel that the techniques don't apply to what you want to do to limit risk in your portfolio and generate income, send it back to us. We'll refund your purchase price. We will ask you why you feel it won't work, or if you feel it's too complicated, we'll try to help you. But if you've come to the decision that it's not for you and you want to return it, no questions asked, we'll refund your money for the position. We're going to start off the same way we like to start off married put positions but never get a chance to. This means that you're bulletproof if you pick up the blueprint. You've got nothing to lose if you pick up the blueprint. If you're not satisfied with it, send it back to us. We'll refund your money. The other bonuses, the members-only webinars. You pick up the blueprint, you're going to have access to the Blueprint Owners Archived webinars, various white papers which show case studies and other concepts, alternative income methods, playing the bear side of the market, as Jay asked as well. That's a webinar that's archived for Blueprint owners. And you get an invitation to our live webinar coming up Thursday at 12 noon Eastern Time, focusing on the 12 different income methods. A more in-depth discussion today, but looking at the 12 different income methods. Why am I doing that? Shouldn't everything that an investor needs to trade radioactively in the Blueprint? Absolutely it is. But sometimes it does help to see a more visual presentation, to see it in action, to see it with new trades, to see it with live trades, to walk through the thought process of how someone who's traded the radioactive techniques for 6 or 7 years applies them in their personal account. Okay? And then as you're watching that discussion, you'll be able to say, oh, well, Mike decided that he wanted to do this. I didn't like that. That's perfect. That shows you exactly, again, why there's 12 different income methods, because you might have traded it differently, but you can at least walk through the process and you'll see the risk-reward profile. So you can only get into Thursday's webinar of the 12 different income methods, a review of the 12 different income methods, an insight into the 12 different income methods if you purchase the Blueprint or the Home Study Kit prior to Thursday's webinar. And yes, Jay, for those of you that own the Blueprint, for those of you that are Blueprint owners, you'll receive an invitation later today or tomorrow for that webinar, and it will also be recorded for you. You'll be able to access it in the Blueprint Owners Only Webinars section. It won't be available to everyone. It won't be posted on the site for free as well. Okay? All right. Let's see here. MAN says, I purchased the Blueprint and the CDs today. I reside in Hong Kong. How long will it take to come through? In general, we send the blueprints out through U.S. priority mail. Inside the U.S., it usually takes about 2 to 3 days, sometimes less. And internationally, it can take as much as up to 5 days. So I'd expect, even in Hong Kong, you should have that in about 6 days or so. I'm going to say 5 to 6 days because it went out today. I know Greg dropped it off already. It was shipped out today through the post office. They'll probably get it out there, and it'll probably start its journey within the next hour or two. But I'd say within about 6 days or so, MAN, you will have your Blueprint, your Home Study Kit as well. All right, so questions and what next? Feel free to review the archive webinar. I should have it posted by about 5 p.m. Eastern Time this afternoon. Remember, pick up the Blueprint or the Home Study Kit. Go to radioactivetrading.com/iridium, IRIDIUM. You'll see all the special bonuses there. It's a no-risk venture. If you're not satisfied after the first 30 days or so, ship it back to us. We'll refund your money as well. You'll also get those bonuses. You'll get that free Foundations of Radioactive Trading CD, the Quick Action Guide. You'll get the first month of Fusion for only $10, and the first month of Power Options, or a 30-day trial to Power Options, completely free as well. Okay, and in addition to that, you'll get invited to our webinar on Thursday afternoon, but you got to pick up the Blueprint or the Home Study Kit to join us for Thursday. Jay commented, he's asked a lot of questions there, and some, I want to say, in-depth questions, Jay. And they're great questions, don't get me wrong, I'm not saying that, but you asked some in-depth questions there that are more related to someone who owns the Blueprint, and he says, for those who haven't bought it, I have high expectations, and the Blueprint exceeded his expectations. So that's fantastic. So the questions Jay was asking about, why not go more than 20% in the money? Would you, apply this particular income method? What do you do if the stock falls? And Robert asked the same questions. Those are absolutely the right questions to ask. Jay's asking him because he is a Blueprint owner, and he's been experiencing it. But thank you for the vote of confidence there. Jay does say that the Blueprint exceeded his expectations. So it's a no risk to you. I think it'll exceed your expectations as well. Pick up the Blueprint or the Home Study Kit, and then I'll look forward to seeing you on Thursday when we review the 12 different income methods. Ladies and gentlemen, thank you for joining me. Again, we'll send you all an email when the presentation is posted in the archives, and I hope to see you on Thursday. Take care. Good night.